In this section, we'll cover indicators that can be incorporated into your trading strategy. Understanding some of these indicators can help you understand past market trends and how they may predict the future market movements. Statistical analysis of market data can be key to staying ahead of the markets. The ability to spot these trends using well-defined data points and historic charts can be the difference between success and failure. There are many types of market indicators that have been developed over time, so we'll only cover some of the most important and widely used. It is also important to understand the relationship between data points and how they can be used together for a stronger confirmation of the market's direction. A golden cross signal is when the short-term moving average crosses over the long-term moving average. If it holds this pattern, it can be seen as a strong bullish signal. There are three parts to a golden cross. First, a sustained downtrend that reverses upwards as the selling pressure fades. In the second phase, the shorter moving average continues to climb and crosses over the longer moving average. And finally, the third phase would be confirmed when there's a sustained uptrend. A death cross is very similar, except with the price moving in the downward direction. This time, the shorter moving average will first rise faster than the longer moving average, followed by a downward trend that eventually crosses the longer moving average. This can be a sign of a longer downtrend to come, confirming that there is a death cross signal. There are varying opinions on what the time frame is needed to constitute a true golden cross or death cross signal. Most analysts would agree on a 50-day moving average and either a 100 or 200-day moving average. The Relative Strength Index was developed by J. Wells Wilder and published in 1978. RSI is a momentum oscillator that measures the magnitude and momentum of recent price changes to evaluate overbought or oversold conditions. As a purely technical indicator, it doesn't factor in outside influences such as earnings and other market news or conditions. The RSI oscillates between 0 and 100, and above 70, it's overbought. Below 30 is considered oversold. The basic formula is shown here. Relative strength, or RS, is generally calculated over a 14-day period. The first step to calculate the daily averages up and down over the given period. Then take the ratio of the average up over the average down to calculate the relative strength value, RS. Of course, your trading software should be able to handle most of the heavy lifting for you, which means you can focus on the signals instead of the math. RSI provides signals that can identify a general trend as well as signaling a likely reversal. It's best used in conjunction with other indicators, especially since it can remain overbought or oversold for long periods of time during bear and bull markets. There are too many types of volume indicators to reasonably address them all. Instead, we've already covered several in this course, and I'd like to briefly highlight a few important volume indicators that you may want to learn more about independently. OBV, or on-balance volume, measures the cumulative selling pressure by adding the volume up days and subtracting the volume on down days. If an asset closes higher than the previous day, all of the volume is considered up volume. If it closes lower, then it is considered down volume. It can be helpful with spotting and confirming trends of the underlying asset. VPT, or volume price trend, is similar to OBV, but it combines price and volume and can help confirm or predict price trends. By taking the trading volume and multiplying the percentage of change over a given period, which would usually be 1 day, you can obtain a better understanding of the money flowing in and out of the asset. AD, or accumulation distribution, is a cumulative indicator using price and volume to identify if an asset is being accumulated or distributed. By determining the proximity of the highs and lows between closing prices, you're able to follow the money flow in and out of the asset. It is a useful tool to spot divergence between price and demand. The VWAP, or volume weighted average price, shows the average weighted price of an asset during a trading session. The average is adjusted for volume by dividing the value of the asset with the trading volume for the session. It can be used as a daily baseline for an asset's price. Generally, traders will use the average to gauge strength and interest in an asset and try to target entry points below the VWAP. Fibonacci levels are one of the most widely used indicators in technical analysis and make a very good tool to fit into your personal trading strategy. But why are they so consistent at predicting retracement levels? Well, no one actually knows. The Fibonacci sequence is found all around us in nature, from our cells to the petals of flowers and even the layout of our own galaxy. The Fibonacci sequence can be traced back to as far as 200 BCE in Indian literature. It was popularized by Leonardo Fibonacci in his book Liber Abaci. In trading, the Fibonacci values are charted as lines on top of a candlestick chart. They're used to identify likely retracement levels, which can also become areas of resistance and support. Charting the swing high and the swing low in a desired period and using a Fibonacci tool, you're able to spot common retracement levels. The most common levels used are 23.6, 38.2, 61.8, 78.6. Additionally, though not actually part of the sequence, 50% is also used as this very common level for retracement. Like other indicators, they're used best in conjunction with other signals. Popular areas where moving averages and fib retracement levels intersect might be places to look at. By observing these areas of interest and paying close attention to candlestick patterns and other signals, a smart trader can make a difference in the quality of their decisions as they enter and exit positions.
Hey mugs, Taco here again to quickly show you an example of the Fibonacci retracement levels tool and how you can use it to make more profitable trades and identify key levels. For myself, I use this tool to identify some areas where there would be a great interest for buyers and sellers to step in, which is great for finding an entry or exit of a trade. So on TradingView right here, you'll find that the fib retracement tool is right here. And for me, quickly, I'm on the 12-hour time frame. In order to find where to start, okay, we must find the swing high and the swing low of whatever time frame that you're using. Map it out kind of like this. So I'm actually going to go off the top of the wick, right? Okay. And you drag it to the swing low, okay? Right there, okay? So that's the last closed candle with that point here, and here we go. So if we drew that out and use these levels as key areas, you can see that, right? These levels actually coincide with a lot of areas of support and resistance, okay? If you scroll back, you can see that these levels have been actually pretty well respected, and you can find these levels with the Fibonacci retracement, okay? So if we were to keep going down, another key area, even though we don't have data, but just based off of the Fibonacci retracement tool, this would be a kind of a key area, right? Now, we're not going to hold these as the holy grail and the be all end all, but at least there's some areas where you can start bidding or start selling in terms of price action, okay? So for example, if this were to go up to here, you could sell, or if it goes back down to here, you could buy, right? So again, this is just a quick way how you can use the Fibonacci retracement tool in getting the best entry and exits for your trades.
Elliott wave theory describes trends in financial prices resulting from investors' predominant psychology. Swings in mass psychology repeatedly show up in recurring fractal patterns called waves. The goal of Elliott wave theory is to trade the large impulsive waves that contain confirmed indicators and trends. The ideal way to trade these is to buy during a corrective pullback wave in an uptrend, or by selling short during a corrective wave in a downtrend to ultimately profit off the wave's next leg. The impulse move of an Elliott wave follows a 5-wave pattern as seen here. It consists of alternating waves, including 3 impulse waves up and 2 corrective waves down, which are used as potential entry points. Finally, the Elliott wave ends with a reversal in a 3-wave ABC correction move. These patterns occur on multiple time frames as well, but just because you see it on one chart's time frame doesn't mean the same rationale will play out in the longer term. Here are 6 common considerations used in Elliott wave analysis. Although not an exact science to swear by, they can improve the timing of your trading strategies, but no single indicator alone should dictate any trade. A rule for wave 2 is that it is typically 60% of the length of wave 1 on average. It cannot drop below the start of wave 1, or you have to restart your wave count. A rule for wave 3 is typically the largest of all of the 5 waves and cannot be the shortest impulse wave. The price must make a new high on wave 3, and if it does not, you have to restart your wave count. A rule for wave 4 is typically 30 to 40% the size of wave 3. It should never cross the same area as wave 1, and if it does, you guessed it, you gotta restart your wave count. As a guideline for wave 1 and wave 5, they're typically a similar length, and when wave 3 is the longest wave. A guideline for wave 2 and wave 4 will alternate, one being a flat correction and the other being sharp. A guideline after wave 5 is uptrend. Third wave of a reversal will typically be priced near previous wave 4's low point. Technical analysts rely heavily on Confluence to support their trading decisions. In technical analysis, Confluence typically requires several indicators of a buy and sell signal combined together to affirm a trade decision. One of the most common points in technical charting where a confluence of indicators is used to determine a signal is at a potential reversal. Reversals are commonly known to occur at resistance and support levels drawn on the technical chart. A price approaching a particular resistance or support line has the potential to reverse or to continue pushing through the trend line, which can send mixed signals. Thus, traders will often watch for several indicators occurring simultaneously or within a short time frame to confirm the trend or break of a trend through confluence. You might think that with a confluence of reasons you are invincible. You cannot lose. That is incorrect. Confluence trading is not the holy grail, but it does offer us a prudent approach and an edge to trading the market. The key takeaway is understanding data points and how to easily spot and track trends that will make you a more successful trader. The more data a well-trained trader can acquire and quickly understand, the better the decisions they can make. Again, it's always best to use multiple indicators in conjunction with each other. Multiple signals can and should be used to confirm an individual indicator is accurate. CryptoMonk's content is not financial, tax, or other advice. Never transact based on it. Do your own research and consult certified advisors. Investing is risky and you could lose everything.